Hello, this is Mijun from Mizung Silon University. Let's start today's big dosing news for September 11th. Welcome to Mijun, who continues to uphold the fundamentals of United States stock investing, as always, Mizung Silon. When I used to live in the United Kingdom, I had a lot of complaints about the United Kingdom's medical services. I think I've mentioned this to you a couple of times on the show. Most of the medical services in the United Kingdom are free, so if you live in the United Kingdom, whether your illness is minor or major, even big surgeries are all free. Because of that, for people who are struggling financially and have a serious illness, it's an incredibly valuable service. However, for people who have minor chronic illnesses, it can be a very frustrating service. About a year ago, I had some pain in my arm. I don't know if you remember. It's called a nerve pinch. Is a pinch also a nerve? Anyway, this nerve kept getting pressed, so my arm was really painful. At that time, I struggled for almost half a year, and I had to wait more than 3 months just to see a specialist doctor. So what I felt at that time was this. I often thought, even if I have to pay a little out of my own pocket, how nice would it be if I could see a doctor right away whenever I was sick? Besides, in the case of dental care, it's not free either. So even for something simple, like removing tartar, it really costs a lot of money. I kept having bleeding gums and needed some treatment, so I went, and the treatment cost was several million won. So, just because there are free services doesn't mean it's good. I often thought about how lucky countries like South Korea are to have reasonable medical services. Now, I'm living in Malaysia, and Malaysia is the complete opposite. Here, just like it used to be in Korea a long time ago, here, if you go to a pharmacy, the pharmacist can dispense medicine even without a prescription. So recently I caught a cold, and when I went to the pharmacy and told them, they gave me a bunch of medicine. Back when I was in England, if you went to the hospital with a cold, you would just have a brief consultation. They never give you any medicine? In the minds of British people, the dominant idea is that a cold will just go away after a week. Even when there was the coronavirus, there were people who didn't give out medicine. It's the same for minor colds, body aches, or even the flu when it comes to passing illnesses like that. They do give preventive shots, but other than that, they don't provide any medicine for treatment. But this time, when I told the pharmacy that I was feeling a bit sick, they gave me 3 different kinds of medicine. One is for clearing phlegm, one is to suppress coughing, and one is to reduce fever, so I'm taking quite a lot of medicine. But actually, my symptoms are getting worse. Honestly, my condition is so bad today that I might not be able to do the broadcast properly. And what I realize is that whether I take medicine or not, it's the same. With a cold, you just have to be sick for about a week. The best thing is just to rest. That's what I thought. Now that the change of seasons is really starting, I hope you all take care not to catch a cold. I also think that after a few more days, since I've been sick enough, I'll probably recover. That's what I'm hoping for. I've been coughing a lot since yesterday, so I can't speak loudly. That's why I'm holding the microphone close and speaking quietly right now. Please don't think that I'm lowering my voice to sound cheesy today. I hope you understand that I'm just doing my best in my own way. Today's Big 2 news prepared for September 10th starts right now. Big 2 news. At the end of yesterday's broadcast, I asked for your comments, and these days, so many of you are leaving comments. Today, I'll read one of the comments before we move on. This comment is from someone with the username Sunny Park, and they said they're always grateful and enjoy watching. Your positive outlook on the world while investing in stocks is wonderful. Unlike others who come to Major One, I've just been sighing for a few days and it's completely quiet. As a beginner with small investments, I didn't renew my band subscription and feel frustrated. Are there plans to continue offering renewal discounts? I would appreciate it if you could do that. For the time being, I don't have any plans for a membership discount event for Mijuan. But lately, there have been a lot of people sending me similar messages, so I've been replying to each one individually. If you look here, I've written down my email. This is my personal email account. Joy2121 at Hotmail. It's .com. If you send your contact information to this email address, I will personally help you become an annual member at a 50% discounted price through our membership manager. It seems there won't be any promotions for the next few months. Since we're using this method, even though it might be a bit inconvenient, if you send it to me by email, I'll follow up with you. All right, and let's continue reading. I sold a stock after a choice stock sell signal, but it's rising a lot. Maybe I shouldn't sell right when there's a sell signal. I wish you even more health and happiness. You said you sold, but the stock went up a lot. It's important for you to approach choice stock probabilistically. As I always say, there's nothing certain in stock investing. So our goal should be to have a probability that exceeds 50%. Now, if you keep making a lot of bets with a probability over 50% like this, your investment funds will keep growing like snow without you even realizing it. So if you think that choice stock is always 100% accurate, or that what Mijun says is 100% reliable, you might run into a lot of difficulties if you approach it that way. Overall, when you look at the probabilities, it's true that the success rate of choice stock signals is over 50%. But even so, if there are 10 signals, 3 or 4 out of those 10 signals could be wrong. I hope you'll always keep this in mind and take it into consideration when applying it. Today, I'll begin by summarizing yesterday's United States stock market conditions. First, look at the S&P 500 map. Yesterday was also mixed. About half of them went up, and it looks like there are a few more reds than greens. So it seems that about 40% are going up and more than 60% are going down. Now, recently the stocks that are rising and the ones that are falling are showing a dramatic split. Now, we usually call this kind of market a stock picker's market in professional terms. That's because while the overall market returns are just average, the stocks that are going up keep showing very strong growth rates in this kind of market. Therefore, which stocks you choose to invest in becomes extremely important during this period. As I explained yesterday and the day before, the market currently has overlapping positive and negative factors. Therefore, stocks affected by negative factors are not doing very well, while those that are influenced more by positive factors are seeing their prices soar. That's how you should see it. Currently, the main negative factor is the economy. Therefore, since the labor market is showing signs of a sharp slowdown, stocks that are linked to the economic situation aren't showing much excitement. For example, mega tech companies that are tied to the economic situation, like Amazon, Tesla, Google, and Meta, are representative. These companies perform better when the economy is doing well. Cars sell well, e-commerce does well through Amazon, and since Google and Meta are advertising companies, the economic situation is very important for them. It's the same for Apple as well. When the economy is good, the various devices that Apple sells also sell well. Therefore, these companies can only show good performance when the economy recovers. That's how you should see it. Alternatively, looking to the left, you'll see the green is quite bright overall. What that means is there are a lot of stocks that have surged. Now, the stocks listed here aren't really affected by the economy. These are companies people invest in for structural growth from artificial intelligence, and they're currently experiencing this growth. Even if the economy struggles, lower interest rates are enough. If there's good news about rates, meaning inflation is controlled, these companies' stock prices can still rise. That's the perspective to have. In fact, just yesterday there was good news about inflation and interest rates. The United States Producer Price Index was announced and it dropped unexpectedly. What does this mean? The market forecast was up 0.3%, correct? But it turned out to be negative. That's how you can see it. And it's the first time we've seen a negative number since April. Let's read it for a moment. In August, the United States Producer Price Index, or Producer Price Index, fell by 0.1% compared to the previous month, marking the first decline in 4 months. Now, this suggests that despite President Trump's tariffs, companies have been absorbing the increased costs themselves rather than passing them on to consumers, holding back on raising prices. Also, a 0.2% drop in service costs led the overall decline in prices. The prices of goods, excluding food and energy, rose by 0.3%. This part is very positive because out of the two factors, product prices are linked to tariffs and exchange rates. So there is a possibility that prices could temporarily spike due to tariffs. In the long term, we can expect that this upward trend won't last forever. But service costs are different. Since service costs aren't related to tariffs, if even the service costs that have nothing to do with tariffs go up, it makes us feel that the inflation trend is not easy to deal with. But fortunately, service costs showed a 0.2% decrease, so you can see this as very positive news. The United States Producer Price Index often serves as a leading indicator for the Consumer Price Index being announced today. What does it mean when the Producer Price Index shows a negative figure? This means the United States Consumer Price Index could be controlled within the next 1 to 3 months. In this way, you could say it was a good opportunity for us to dream of a rosy future. So what about the United States index yesterday? I think we saw a polarization where the stocks that were falling kept falling, and the ones that were rising kept rising. That's how I would sum it up. The S&P 500 and Nasdaq 100 both closed in positive territory. That's because major stocks like Microsoft and Nvidia surged sharply. Now, if we look further down at the performance of the 11 sectors, it's the same story. Tech stocks led yesterday, gaining 1.81%. Next, we'll examine the market's breadth. As I explained earlier, yesterday, as the stock pickers market really took off, the rising index actually led to a narrower market breadth, right? It dropped to 53 and 67, and just a few days ago, the market breadth had gone up to 60, but it's gradually narrowing. So stock selection is very important. Even stocks with good long-term trends have suddenly dropped to 60 and 03. Therefore, if the downward trend strengthens just a little more, you can see that there's a risk the market range could shrink to below 60. Next is the volatility index. The volatility index is still good at 15 and 35. So, the fear index is still showing a very calm state. The fear and greed index is the same. It's at 51, so it stopped at exactly the same spot as yesterday. You can see this as a positive sign as well. The market score is now 87, just 1 point down from yesterday's 88. So, as you can see, the market sentiment continues to trend upward. But here, there's one thing we need to remember. Today, the Consumer Price Index will be announced, and the market's expectations for the Consumer Price Index have risen significantly. That's because yesterday's Producer Price Index was good, so people are quietly hoping that today's Consumer Price Index will also be positive. Therefore, if unexpectedly high inflation numbers are announced, we need to remember that the mood could suddenly cool down. Next is the performance of me on top pick. As I mentioned earlier, the stocks that led the market yesterday were artificial intelligence beneficiaries, so my on top pick performed very well. At the very top, Credo Technologies soared by 10.02%, and now it's showing an upward trend of nearly 20% in just 1 week. The second best performing stock was Broadcom, which surged by 9.77%, and third was Vistra Energy, which rose by 7.96%. Astera Labs rose 7.40%, B2 3.88%, Nvidia 3.80%, Taiwan Semiconductor Manufacturing Company 3.79%, Celestica 3.67%, Talos Energy 3.39%, Palantir 2.70%, Advanced Micro Devices 2.39%, and Tesla 0.36%. Bitcoin went up to 114,000 and Tesla also rose by 0.24%. On the other hand, yesterday, 4 stocks were in the red. Alphabet dipped 0.19%, while Strategy fell 0.63%, reflecting recent performance. Coinbase dropped 1.08%. Lastly, Meta Platforms dropped by 1.79%, showing the worst performance. Alright, then let's move on to today's main article. At the beginning of this article's title, I wrote that it's a Mijon recommended content, and of course that's also true for the content of the article. Later, I'll read Mijon's comment together with you, and through that, I think I can explain to you a general strategic aspect of stock investing. I've prepared this opportunity for us to study together about an important aspect when evaluating stocks, which is the rate of return. Aside from Mijon topping in the article title, a rather unfamiliar stock comes to mind. Oracle is mentioned, right? Oracle isn't a new company, but it's a company I've hardly ever talked about on the show. But yesterday, Mi-hook Jung-si basically dominated with Oracle. If I show you the content I posted on the Mijon membership, Oracle keeps coming up. If you look here, this stock has emerged as a next-generation artificial intelligence beneficiary thanks to Oracle. Now, let's read this together. Right next to it, there's an artificial intelligence beneficiary stock that had its best day thanks to Oracle, and there's also a dubbed video here. Oracle, the top stock of the artificial intelligence era. That's how much yesterday, thanks to Oracle, Mi-hook Jung-si really gained tremendous momentum. Let me start by telling you that story. Oracle's amazing growth prospects have reignited the enthusiasm for artificial intelligence, and as a result, one semiconductor company in particular is in the spotlight. Oracle's announcement of massive revenue projections made it clear that demand for artificial intelligence workloads will continue. I shared my opinion on this yesterday after reading a comment from a subscriber. The subscriber was concerned, right? If demand for artificial intelligence workloads slows, those of us invested mainly in artificial intelligence beneficiary stocks would be impacted. But I expressed a different opinion. In my view, the problem is if the demand for artificial intelligence workloads slows down. Rather, if the artificial intelligence era comes too quickly, people could lose their jobs and the consumer base could collapse because of that. That was the outlook I had. Anyway, what happened yesterday was that a company called Oracle announced its sales outlook, and it was an incredible sales forecast. So they sent a message to the market that artificial intelligence workloads will clearly continue for some time. What's the reason for this? It means that beyond the resource-intensive training phase of artificial intelligence models, artificial intelligence has now shifted to the inference stage. I'm sure you all remember inference. Artificial intelligence is trained with a lot of data, right? And then, using what it has learned from this training, we put artificial intelligence to use. Using artificial intelligence is what we call inference. I think that's a good way to summarize it. Here's the definition. The inference stage is defined as the process in which a pre-trained model makes predictions and draws actual conclusions based on new data. In the market, it has been expected that the inference stage in the artificial intelligence cycle would bring higher profits, and many investors believe that Broadcom will be the biggest beneficiary. That's because Broadcom is a leading supplier of chips that are more suitable and cost-effective for inference. So you can see that this makes Broadcom very attractive to hyperscalers who want to reduce artificial intelligence costs. On Wednesday, Broadcom's stock price surged by 9.8%. The reason was the impact of Oracle's stock soaring by nearly 36%. That's how it's explained, and now let's hear from an expert. Stephanie Link, the Chief Investment Strategist and Portfolio Manager at Hightower Advisors, will be joining us. Inference will definitely be the next big growth driver, and Broadcom is clearly the number one player in this field. I think it's hard to call them number one with NVIDIA around. Broadcom is likely number two. So anyway, NVIDIA Advanced Micro Devices and many other companies will benefit, but Broadcom isn't as widely known or as heavily held as NVIDIA. That's why I think it's chosen as the top pick. In fact, so many people already own NVIDIA, and institutions also hold a lot of NVIDIA. However, Broadcom isn't as well known, but its recognition has increased this time. That's how you can see it. The reason Broadcom has performed better than NVIDIA over the past year is because the market has gradually started to recognize its value. That's how it's being explained. For reference, one-year returns show NVIDIA increased by 60.38%, while Broadcom rose 139.08%. Fortunately, both stocks are included in the Mijon Top Picks. Stephanie Link has Broadcom as the largest holding in her portfolio, accounting for 7% of her total funds. So for Stephanie Link as an investor, if a single stock makes up 7%, that means it's her number one holding. This shows she is diligent about diversifying her investments. Stephanie Link has held this stock for 4 years, and after the recent quarterly earnings, she actually increased her holding even more. Broadcom's stock has jumped 56% this year. This company is a leader in the merchant application-specific integrated circuit sector. You've probably heard the term application-specific integrated circuit a lot. The official name is Application-Specific Integrated Circuit. It stands for Application-Specific Integrated Circuit. We call this a custom chip, which is mainly a custom processor used for artificial intelligence applications and networking. What about A-type? Because it uses less power in data centers and is optimized for specific tasks, it's more cost-effective than a GPU or central processing unit. Therefore, it has the advantage of lowering the cost per application. Lowering the cost per application is very important. Because when we ask artificial intelligence a single question, that's considered one application. And as the number of artificial intelligence users increases worldwide, it will eventually result in a huge number of applications. As applications increase, reducing cost per application becomes even more important. It's the best indicator of being chosen. What about Sutupani Linku? She mentioned not only Broadcom's artificial intelligence, but also its high-margin software business and recent acquisition performance as attractive factors. Recently, they acquired a major company, a semiconductor company called VMware, and it's known to be a very successful acquisition. What about Broadcom's revenue? It's split into semiconductor hardware and software, with infrastructure software making up about 41%. It comes from ASICs, networking chips, storage, and controllers. That means software accounts for 41% of the revenue. We can infer that the margins must be that good. Software generally has low development costs and can generate recurring revenue. Once it's made, it can be replicated afterward, so you can see that it's more profitable than hardware. What about Stefan Link? Broadcom is more attractive due to its diversified portfolio and strong performance in artificial intelligence, semiconductors, infrastructure, and software. Now, having a diversified portfolio like this is important from an investor's perspective as well. If our investment portfolio is diversified, even if one stock plunges, the overall portfolio return doesn't change much. It's the same for companies as well. When a company runs multiple businesses, one failing isn't a big issue. That's the perspective to have. But in addition, in the case of Broadcom, not only is their portfolio diversified, they're seeing strong growth in artificial intelligence, semiconductors, infrastructure, and software, outpacing market expectations in all areas. That's the perspective to have. So both earnings before interest, taxes, depreciation, and amortization and operating profit were strong. They reported a gross margin of 78.4%, which is the highest level in the industry. I'll explain this part in more detail in a moment. What are the main expectations for Broadcom? After Oracle quickly became a hyperscaler, those expectations grew even more. So until now, when we thought of cloud companies, only 3 came to mind. Amazon Web Services, that's Amazon. The second is Microsoft, which has the Azure cloud model, and the third is Google Cloud, which has been making great strides recently. But suddenly Oracle is now on this list as well. You can see it as having transformed into the 4th hyperscaler. In its earnings announcement on Tuesday, Oracle reported that its remaining performance obligations surged by an impressive 359% compared to the previous year. They said it hit $455 billion. This is why the market went crazy yesterday. Now, why is $455 billion such a big deal? If you look here, the company expects $18 billion in cloud infrastructure revenue in fiscal year 2026. So right now, Oracle only generates $18 billion in cloud revenue per year. Now, if you look here, the term remaining performance obligations refers to backlogged orders. So due to limited capacity, there are currently $455 billion worth of backlogged orders. That's several times the annual revenue currently backlogged. And in the 2026 and 2030 fiscal years, it is projected that revenue will increase to $144 billion. Fulfilling all the backlogged orders will take another 5 to 7 years, an enormous amount of time, according to them. Oracle's co-founder and chief technology officer Larry Ellison appears. He said this at the earnings announcement. The artificial intelligence inference market will become much larger than the artificial intelligence training market. And many companies are looking for inference capabilities. Right now, there are so many companies searching everywhere for cloud computing power to increase their inference capabilities. I'm saying demand is overwhelming. There were even customers who requested all the unused capacity available anywhere in the world. So there were customers saying, "We'll use all the cloud resources you have." So in the end, all the money we spend on training has to be converted into products and sold. And that's what we call an application. So finally, many companies are not just investing in artificial intelligence, but are also working to turn it into products and make money from it. That's what we call an application. And because the era of applications has arrived, the demand in the application market is suddenly skyrocketing. So right now, the backlog of orders is now dozens of times greater than the current annual sales. So that's what they're boasting about right now. Because this news broke, it's natural that artificial intelligence beneficiary stocks surged yesterday. That's how you should see it. Now, what about you, Mijinho participant? In short, I think it would be good to study a bit more in detail. Today, I'd like to talk a bit about margins. Earlier, experts who Tupan discussed Broadcom's investment value, noting its gross profit margin is extremely high, surpassing all others. Let's take a look here at just how good their gross profit margin actually is. Now, first of all, the gross profit margin is really important. In English, it's called the gross margin, and it's a measure of how excellent a company's business model is. I think it can be even more important than net profit margin. A company with a low gross margin is structurally selling products or services that make it difficult to generate a lot of net profit. That's how you can interpret it. For example, as you know, I used to be a general manager at a hotel. In the case of hotels, the gross margin is very low because structurally, it's a business where it's hard to generate a lot of net profit. What that means is, at the hotel where I used to work, the total number of employees was over 300, but the number of rooms was less than 300. What that means is, no matter how much money you make, because there are so many employees, it costs an enormous amount. So you can see that hotels are businesses that structurally can't generate a lot of profit from the products or services they sell. It's the same with airplanes. Airlines have low profit margins mainly because fuel costs are so high. So airlines try their best to fit as many people as possible into these passenger planes. That's why overbooking happens and Korean Air makes the seats narrower and things like that. The profit margin drops significantly due to high fuel costs, leaving little money remaining. That's the perspective you should have. So whether a company has a high or low gross profit margin, that's the point. It's important to remember that this is a very valuable indicator for measuring how much net profit can be generated through this margin in the future. So if a company's gross profit margin suddenly jumps up when something like this happens, it means that there has been a change in the company's main product or that a change has occurred. It's like a hit new product just appeared. Or the production process was restructured. For example, Amazon is now replacing many workers with robots. When such restructuring occurs, margins could suddenly rise. Or it could suggest that there was a big change in the company's revenue composition. In technical terms, we call this the revenue mix. For example, let's say there's a company that generates 50% of its revenue from hardware and 50% from software. But suddenly, the proportion of revenue from software starts to rise sharply. In that case, the revenue mix is changing. When this happens, the margin can rise sharply. For example, right now, most of Tesla's revenue comes from hardware, almost all of it. But if in the future, revenue from autonomous driving becomes greater, then there's a possibility that Tesla's margin could surge. So the way the gross profit margin changes is actually very valuable information that shows how the company's business model is progressing right now. Also, both the gross profit margin and the net profit margin are important. The net profit margin is important too, because when we calculate earnings per share is the earnings. That is the net profit divided by the number of shares issued. So the net profit margin is really important as well. Now, if these two are high, it means the company is price competitive, serving as a measure of its economic moat. Therefore, finding companies with high margins is very important. Well, the reason is, in order to increase margins, a company has to raise the price of its products or services. The fact that it can raise prices like this means the quality of the products or services it offers is top-notch in the industry. It means it can't be replaced. A company with unique, irreplaceable products like NVIDIA is very valuable. Usually their margins are extremely high. Now, if you keep this in mind and look at the various information I mentioned earlier, I think you'll find it really interesting. So, first of all, there was an article saying that Broadcom's gross profit margin is good. Let's take a look at whether that's really the case. Here I've listed some representative semiconductor companies. At the very top is the gross profit margin. Broadcom, that's Broadcom. 77.17%. That's impressive. Yeah, it's higher than NVIDIA, which is at 69.85%. Advanced Micro Devices is 50.99%. Taiwan Semiconductor. Manufacturing company is 58% Micron. Micron is 37%. Qualcomm is 55%. And Intel is just 32%. Now, since the gross profit margin is so high, you might assume that the net profit margin would also be the highest, but that's actually not the case. If you look here, the net profit margin for Broadcom is 31.59%. Of course, having a net profit margin over 30% is incredible. That's a really good margin. But if you look next to it, NVIDIA has 52.4%. Now, why is 52.4% so good? If you look next to it. Advanced Micro Devices doesn't even reach 10%, so there's about a five-fold difference. Actually, it's more than 5 times the difference. So even if Advanced Micro Devices sells 5 times more than NVIDIA, their net profits would be equal. That's how the numbers add up. That's how remarkable NVIDIA's net profit margin is. Taiwan Semiconductor Manufacturing Company is also impressive at 42 to 48%, and Micron next to it is at 18.4%. Qualcomm is at 26.7%, which isn't bad either. Finally, Intel stands at 38.6%. There's a minus sign, so the gross profit margin is a positive 32%, but the net profit margin is now minus 38%. That's Intel's reality. All right, let's sum this up. As you can see here, Broadcom's gross profit margin was 77.17%. This is almost unbeatable. It's really hard to find a company with such a high gross profit margin. 41% of the sales. Because it comes from infrastructure and software, the gross profit margin is actually higher than NVIDIA's. Now, even though the gross profit margin is this high, you might wonder why the net income margin is lower. They've aggressively pursued mergers and acquisitions, including VMware. So the reason why 41% of Broadcom's revenue can come from software is because they've acquired a huge number of software companies. When they make these acquisitions, the money goes out as capital expenditure. But the problem is, when there's a lot of capital expenditure like this, it later gets written off as depreciation expense. Expenses keep piling up, and that's not all. Broadcom must invest in R&D to keep developing software, resulting in high operating expenses and a relatively low operating profit margin. The main reason is their ongoing mergers and acquisitions leading to high depreciation expenses. We need to recognize this. Now, on the other hand, NVIDIA is a bit different. That's because NVIDIA doesn't run multiple businesses simultaneously like this. NVIDIA only sells GPUs. So, since they have a business model focused on GPUs, a significant portion of their revenue comes from high-value added artificial intelligence chips. Their cost structure is relatively simple and efficient. So NVIDIA is a company with a very high operating margin. I think that's how we can sum it up. Now, as I mentioned earlier, by looking at the changes in gross profit margin, we can get a sense of how this company's business model is evolving. Let me show you just a few examples. If you look at the trend in Broadcom's profitability, it's quite impressive. Gross profit margin averaged 74% over 5 years, recently rising to 77%. Virus. Scientists specifically test and explain, or sometimes Agilent does this in a few days. That's right. Therefore, you can see that it is evolving significantly. The net income margin has decreased further. The 5-year average is 36%, but over the past year, it's exceeded 52%. NVIDIA's GPU is now number 1, holding nearly 90% market share. That shows just how dominant they are, and you can see it in the changes in their returns as well. You're probably wondering how Advanced Micro Devices is doing. Actually, it's the opposite of NVIDIA. Gross profit margin, total margin, what about it? The 5-year average was 49 and now it's 50. There's no real change. But if you look at the net income margin, the 5-year average was 11, now it's 4, and the net profit margin has actually dropped a bit. So now that the artificial intelligence revolution has started and semiconductor companies' margins are improving, it's really curious why advanced micro devices' margins have actually dropped. We can easily guess the reason for that. Because advanced micro devices has a very low market share and is the second-ranked company. Therefore, in order to compete with NVIDIA GPUs, the only option is price. They have to lower the price for people to buy it. So they're setting a lower price to compete with NVIDIA GPUs. We can also see this from the fact that their margins are dropping. Let me summarize it like this. Alright, since we've talked enough about artificial intelligence in today's broadcast, I'd like to wrap up today's show by talking a bit about Bitcoin. The last content we've prepared is, of course, a dubbed video. It's today's United States stock market video. In today's United States stock market video, our favorite Tony appears. And Tony, by the end of the year, the price of Bitcoin will reach $200,000. What was the current price again? Let's check it once again. Bitcoin has gone up a lot to $114,000. Not long ago, it was $110,000. So even at $114,000 now, the price of Bitcoin could reach $200,000. That's quite an impressive outlook being presented right now. Now let's see what kind of reasoning Topney has for predicting such a rosy future. Let's listen to what he has to say. That's all for today's United States stock news on September 11th. I hope today's broadcast was at least a little helpful for your investment activities. If you are satisfied with today's broadcast, please give us a like and leave lots of comments. There is an important catalyst today. The Consumer Price Index results will be announced at 8:30 ante Meridium Eastern Time in the United States. Please make sure not to miss it. Let's all keep going together until the day we retire from investing in United States stocks. Have a happy day. Thank you.
Joining us is Tom Lee from Fundstrap Global Advisors. Good morning. The debate we're having right now about this employment indicator, it might even be a debate happening at the White House. I'd like to hear your thoughts on what this means for the economy and therefore how it might affect the Fed. Federal funds futures now predict nearly 3 rate cuts by year-end, up from about 2 or 3 before. After the jobs report, the bond market essentially judged that the labor market is now moving further away from the Fed's target than inflation is, and therefore justifies one additional rate cut.
I think this is reasonable. Because even though the August Consumer Price Index, which will be released this week, may show a slight increase in prices, the market will start to see this as a temporary factor. On the other hand, once weakness in the labor market begins, reversing the trend is very difficult, so I think the Fed should intervene quickly.
Do you think at least 3 rate cuts are needed this year?
In my opinion, what the bond market is reflecting is essentially 3 rate cuts, but the Fed is talking about 2. This means that the Fed is lagging behind in recognizing the changing situation compared to the bond market. So, I think the Fed might address this in its interest rate decision at the Federal Open Market Committee meeting on the 17th. If that happens, the bond market will feel relieved that the Fed has acknowledged the weakness in the labor market, and it will be good news.
The Fed can cut interest rates and control short-term rates, but not long-term rates. What do you expect will happen in the long-term segment? Do you think there will be an impact on the mortgage market?
There are some concerns regarding long-term interest rates. I know that globally, especially the 30-year bonds, have continued to rise. The Federal Reserve and other central banks admit their monetary policy greatly affects bonds up to 5 years with up to 90% correlation. For bonds with maturities of 10 years or more, the market moves independently based on growth prospects. That's a bit concerning. On the other hand, I think mortgage rates could come down significantly. Currently, the spread between the 30-year mortgage rate and the 10-year Treasury yield is over 300 basis points, while the 50-year average is about 160 basis points. Therefore, if the Fed resumes rate cuts and the bond market interprets this as a move toward easing, the 30-year mortgage rate could drop by about 150 basis points, even if the 10-year yield doesn't move. This would have a significant easing effect on the housing market.
That's an important question. You're not an economist, but you probably have some views on where the economy is headed. If the Fed cuts interest rates and despite the difficulties we've seen in the job market, the economy doesn't decline sharply, that's one scenario. However, if interest rates are cut and at the same time the economy slows down, and on top of that there's a possibility of a recession in the future, that's a completely different story. Do you see this rate cut as a measure that economists consider possible for good reasons to improve the economy, or are you concerned about the consequences that may follow after another cut?
I believe this rate cut will have a fairly constructive impact on the economy. The 30-year mortgage rate is pressuring the economy and the housing market has slowed dramatically. However, significant potential demand for housing is also building up. Therefore, in order to ease the imbalance between supply and demand, the housing market definitely needs improvement. Also, the Institute for Supply Management Index, which measures business confidence, has stayed below 50 for 31 consecutive months, which is the longest period since the Institute for Supply Management was created. If the Federal Reserve starts to lower interest rates, business confidence is likely to recover. Easing mortgage rates and improving business confidence will boost the economic cycle, which is why I believe small-cap stocks have been the second best performers after the Magnificent Seven in the past 8 weeks.
Scott Best said that the economy is actually in better shape than people think and that employment indicators will improve going forward. How does the outlook affect your judgment, or do you not consider it at all?
Treasury Secretary Best partly agrees with Barron. There are 2 reasons. First, if you look at corporate earnings reports, there is no sign that more companies mentioned a slowdown in business in July or August. Though the job market appeared to decline recently, the real business environment did not reflect this. In fact, even in the Fed's Beige Book, most regions reported that conditions are improving. This is the first reason. Second, we know that the job market goes through a lot of revisions. If we look at the benchmark revisions coming out in September, it may actually show that the job market has been weak throughout the year and that the last few months have actually been stable. So I think Secretary Beson's view is partly correct.
Lastly, please tell us about Bitcoin. Currently, it's around $111,000. How do you see its potential for further rise and the risk of decline?
Cryptocurrencies like Bitcoin and Ethereum are extremely sensitive to monetary policy. September 17th will be an important catalyst. Cryptocurrencies have traditionally performed well in the fourth quarter, so I think Bitcoin can easily reach $200,000 by the end of the year. This is a major increase, almost double, and also a significant risk factor.
You mean it will double? Hold on a second. Currently, Bitcoin is at $111,000. Are you saying it could reach $200,000 around Christmas?
Yes, that's right. Bitcoin has been sluggish this year because the Fed paused interest rate cuts for 9 months. A rate cut cycle has only restarted in the fourth quarter after a long pause twice, in 1998 and in 2024, both beginning in September. Each time, the stock market did very well. Since cryptocurrencies are closely linked to stocks, I think the fourth quarter will also have strong momentum. In particular, the small cap index is also likely to rebound, and Ethereum, which is closely linked to small cap stocks, will also show strength.
Are you confident the bull market will last through year-end given the recent rate cuts? So, you're not interpreting the situation as bad news being disguised as good news, but rather that the good news is genuinely that good, right?
If there hadn't been this much skepticism about stocks, I would have been more cautious. This year, the S&P is up about 10%, yet the American Association of Individual Investors net bullish minus net bearish indicator has been negative for 5 straight weeks. Despite record highs, investors remain bearish. This skepticism is clear among our institution and clients. I think most people are preparing a defensive stance from September through the end of the year. That's why I believe the stock market will actually surprise investors on the upside.
That's why I think the stock market will actually surprise us by going up. Grow a little every day and enjoy today's journey. Even if dark times come, I'm not afraid. Retiring with United States